Hello friends, Namaste and welcome back to my channel. Today I will be basically discussing about systematic risks and unsystematic risks. How could we measure these two risks with the example? Before moving to the topic, we have to understand the reasons behind the diversification. It's very important to diversify our risks through proper investment strategy that I discussed in my last video. From investors' point of view, we say the risks could be either systematic risks, which is also known as the market risks, which cannot be diversified and resulted from the macroeconomic factors such as changes in the market interest rate, changes in the tax rate, political instability, world recession, etc. While unsystematic risks, which is also known as we say the your company specific risks or diversifiable risks, which could be diversified with proper investment strategy and resulted from the company specific factors which are internal to the company and which could be managed. Now the question about how could we measure the systematic risks? Well, beta coefficient is the important index of systematic risks, which basically measures the stock sensitivity to the market fluctuations, and which is the ratio of covariance of return and the market by variance of the market. Here I have used the B is the beta and Naval is the, let's say, the Commercial Bank of Nepal case, right? Now how we analyze the beta value. If beta equals to 1, it shows that stock price move with the market, like the NEPSI, Nepal Stock Exchange Index. If beta is lower than 1, we say the stock price is less volatile than the market. Similarly, if beta greater than 1, it shows that stock price volatile than the market. Now, we have to note it that if beta value is negative, what it shows? It shows about the stock price moves in opposite direction of the market. And covariance of returns, which is say that asset returns move together if we have a positive value. If we have a negative value, we say that is inversely related. That would be the part of your beta calculation part. Now let's move to the one example that I have taken from the financial management book of I.M. Pandey. Before moving that, let's briefly discuss about the unsystematic risks, which is the difference between total risks, which is measured by sigma, and systematic risks, that is the beta value. In the financial models, unsystematic risks could be represented by the error term or residue in the regression analysis. For example, if we are taking like your return of Infosys, which could be taken as dependent variable, and while BSE Sensex here, that is the market return, could be used as an independent variable. This risk basically tells about the dependent variables could not be explained by the, let's say, the market returns. Now let's move to the one example, that is in one column we have a, let's see, this is the year, market return is there. Third one is the Infosys returns, and at first we need to find the average returns. Take the sum of this one and then calculate the average or expected return of the market. Similarly, you could find the for Jaya Infotech expected return for this case, that is the RJ. Then we get the difference between RM minus ERM and similarly RJ minus ERJ. To find the basically the covariance. Covariance is all about, at first we need to get the sum of this value difference, then we get the total, then divided by the number of observation we have of 5 here, okay. And again, since we need the variance of the market as well, then that is the deviation from the mean return of the market square. Then lastly we divide by n, total sum. Then we know that that's the beta is the all about the covariance of, that is the RJ, return of the this infotech, and the RM is the market returns, and that is all about the ratio of this covariance of these two returns divided by the variance of the market. Now, how could we explain, or we say state in the your the regression line, we say no, here RJ is the rate of returns, and this is the, we say the about your, yeah, that you can use by using the Excel also, right? This is your constant and this is your beta value, like your y equals to a b x, yeah. And the variance of the market return, we say that measures the how widely the returns of Jaya Infotech are dispersed around the average return, that we could find by using this formula, yeah, that we use this one. Okay, this much for today. I have basically discussed about the beta value, which could be used as a measure of systematic risks, and the unsystematic risk is all about the difference between total risks and systematic risks. And before making investments, we have to assess the risks so that risks could be minimized. Thank you all of you. Thank you for watching this video. If you like this video and share and comments, that will be really great feedback for me as well. Also provide your feedback. Thank you all of you. Have a great day. Thank you.